Good morning, and thank you all for joining us today. We appreciate you taking the time to be with us. My name is Coulter Regal. I'm a product manager here at Van Eck, and I am also joined today by my colleague, Nico Cortez, who will be sharing his insights with us as we walk through today's discussion. Over the last year or two, we've seen growing interest from advisors and investors in private credit as a source of income and portfolio diversification. Business development companies, or BDCs, have been a key way many investors have accessed this space, including through our own Van Eck BDC Income ETF, ticker BIZD, or BIZD. As many of you know, BDCs and private credit have been an area of high client interest as investors look for yield beyond traditional fixed income. More recently, however, the BDC market has experienced a period of volatility. That has created some understandable questions, and at the same time, we believe there may be also potentially an attractive valuation opportunity relative to BDC's own history, as well as compared to other areas of the high yield market that have not quite seen the same level of price movement over the last few months. So today's webinar is designed to help frame that conversation, and we'll walk through at a high level about BDCs, why BDCs continue to offer a compelling yield potential, as well as kind of dive in a little bit about the recent market volatility and why the long-term fundamentals of private credit, we believe, remain an important consideration for income investors to focus on and to be aware of. We'll also highlight insights from Houlihan Lokey, who puts out a very nice quarterly public BDC industry report that we talk and share a lot with our clients who find it helpful. So we'll walk through some of those slides and reports there. And that suggests that despite some of the negative headlines and narratives that are kind of going around of late about private credit and BDCs, the underlying portfolio construction and the credit quality across the BDC space, remains largely stable. Towards the end, we'll briefly touch on how our product, BIZD, provides diversified liquid access to the public BDC market for investors looking to capture the income and diversification benefits of private credit. But before we get started, just a couple of housekeeping items. We have allotted some time at the end of today's prepared remarks for questions and answers. So you should see a Q&A box on your screen. So please do feel free to submit any questions you have now or during the presentation. Just insert your question to that Q&A box and submit it to us, and we'll work to try and get through as many of those as we can towards the end of our presentation. So with that, let's get it started. Just to kind of start from the top, I think to kind of level set here, I think private credit is an area that many investors over the last year or two really have really been kind of keying in on. I think this chart kind of shows that nicely. This chart is showing basically the AUM, or the assets under management, of the entire BDC space, which is one of the access vehicles that many investors today use to provide exposure to their clients or to gain exposure within their own portfolios to private credit. And you can see here just really over the last few years, and it really started sort of post-COVID, where we saw many of the banking institutions kind of shut their doors in terms of loans to companies right when these companies needed it the most, following the pandemic. And so the middle market lending and private credit area, really kind of stepped up and into that market and filled the gap there, and really provided that lifeline to many of the companies who needed some liquidity and some help during that period where the banks had kind of shut their doors a bit. And that kind of opened up the door to opportunities beyond to investors in their portfolios, and it highlighted, I think, the growing nature of private credit and the advantages in terms of speed and access for many private companies today, when they're looking to gain capital or resources to help grow their business. And so over the last few years, we've seen really a pretty dramatic growth in the whole private credit industry as a whole, but also within the BDC market, specifically public BDCs as well. And I think the trend that we're seeing in the analysis reports that we consume indicate that trend is likely to continue. I believe today that the total private credit market is about $1.5 trillion or so, maybe a little bit more, but within the next 3, 4, or 5 years, that's expected to double again to about $3 trillion. And BDCs and direct lending is definitely a big part of that as well, as you can see here. So, BDCs have really grown and provided that access vehicle for, many investors, to gaining that exposure within their portfolios. Beyond just gaining exposure by private credit, what are the main reasons why are people even looking to this space? Well, I think this is a simple chart that really just shows the current yields of BDCs, which indicate or represent private credit and direct market lending, relative to some of the other sort of traditional, more traditional assets income investors look to. And really, it's largely a yield story. That's sort of the number that attracts the attention for a lot of folks. And here's a pretty dramatic representation of that. So BDCs today are currently yielding about 11%, so a nice double-digit yield. It is a high yield area of the market, obviously. These BDCs and direct lending, are loans essentially to small private companies. And so because of that, there, tends to be a very large credit spread, and you're compensated for that additional risk. And you see that here. So even versus something like leveraged loans, which also sort of operate within the sort of, private credit, market, very attractive yields versus that, as well as high yield, itself. Both of those are sitting around 6.5, upper 6, and particularly, versus some of your more traditional, corporate investment grade bonds, which yield about 4% right now. So you're getting a very attractive yield profile with BDCs specifically, as well as you're getting diversification benefits as well, since the portfolios of these BDCs, these loans that they issue, are predominantly floating rate loans, where the majority of income sleeves within portfolios tend to be duration or fixed in a way, so you get a very nice yield pickup as well as diversification, relative to what many income investors already own. And so I think this is a very nice chart that kind of just highlights that advantage in terms of yield. And then more specifically, talking about publicly traded BDCs, since I think one of the large talking points or key considerations that many investors think about when they're accessing this space is really liquidity. There's obviously these are non-traded private companies, private loans, and they're not trading on a secondary exchange. You can see some level of liquidity in the broadly syndicated loan market, but still it's not quite the same. But when it comes to publicly traded BDCs, that's really where you gain the advantage of basically intraday secondary trading. Publicly traded BDCs trade on major exchanges just like a stock, so you can buy and sell it during the day, just like you would your name your Mag 7 stock. And so you really kind of gain the advantage of liquidity. So you're gaining exposure to the space, these publicly traded BDCs, and you're getting liquidity where many non-traded or private funds might only offer liquidity on a quarterly basis, and even within that, oftentimes there are max redemption limits, typically around 5%, for that quarterly period. So publicly traded BDCs give you a great access vehicle with that liquidity. It is worth noting that liquidity can be a bit of a double-edged sword. It's great to have liquidity, but it also sort of opens up BDCs, publicly traded BDCs, as sort of the release valve if there is any sort of concerns or quality, if reasons for people to want to take some exposure off the table. Typically the publicly traded BDC space is the easiest and the fastest way to do that because it has the liquidity. But by and large, I think that the important point to note here is that even though you can see a little bit more volatility, and this chart shows that, so in the blue line is essentially the publicly traded BDC market cumulative return over the last, say, 10 years. And in the sort of teal line is the aggregate kind of category, return of, private debt funds. And the main difference here is, really just the volatility profile. You see a lot more volatility within the publicly traded space, but that's really just a function of the liquidity profile relative to the lower liquidity profile of private funds. But ultimately, I think the key thing to note here is that, at the end of the day, it provides a very similar return profile over the last 10 years. You ultimately end up at the same spot. It's just that you have a higher level of liquidity, and with that comes a little bit of extra volatility, both good and bad. So, but I think also, if you kind of key in here towards the right-hand side of this chart, I think you'll notice here, and I think what we'll kind of dive into, beyond here is sort of the crux of what many people are talking about or have interest in talking about today. And that's sort of the volatility we've seen, more recently here within, say, the last 6 months or so, particularly within the private credit market, and even more specific, the publicly traded BDC market. Publicly traded BDCs over the last 6 months have seen a bit of volatility, and they've kind of, sold off a bit. There's been some narratives out in the market that I'll hand it off to Nico to talk to here in a second, that have kind of just resulted in some selling pressure versus the BDC market, and particularly, selling pressure that has sort of outpaced other areas of the high yield market. say leveraged loans or even triple C bonds, corporate bonds. We think that potentially that could open up the possibility for a relative valuation opportunity versus the other areas of the high yield market that have not quite seen the same level of volatility. While also accessing high yield and a great way to do that through these publicly traded BDCs. So I think with that, I'll hand it off to you, Nico, to kind of dive in a little bit to sort of the more recent volatility that we've been seeing.
Yeah, thanks so much, Coulter, and thanks for stealing a ton of my thunder on the liquidity and volatility there. And thanks so much for joining, everyone. Like Coulter said, I'm Van Eck's ETF strategist. I cover RIAs across the country, and that really means that my days are spent talking macro trends, portfolio construction, liquidity, and ETF mechanics with some of the independent shops around the US. And like Coulter said, today I want to start with this chart, which is showing publicly traded BDCs and how they've dislocated from the rest of the credit markets. And I really do think that this just sums up the opportunity that we see here today. So as you can see in this chart, over the course of 2025, and more specifically over the past 6 months, publicly traded BDCs have significantly underperformed both senior loans and the high yield markets. And of course, on the surface, this could look a little bit alarming. But the key question here isn't really what's happening, but more why is this happening right now? And that's because BDCs are publicly traded. Like Coulter said, they're daily liquid, but most importantly, they're closed-end vehicles. And this means that they can act as the escape hatch or the pressure relief valve when sentiment shifts, just like Coulter said. So if you're an investor, if you're an institution and you're worrying about worsening credit conditions, especially in private credit, you can't immediately sell your illiquid assets. So instead, you run for the door where you can. And that's why folks have been selling BDCs. And as you can see in the chart again, we first saw this on Liberation Day back in April. Then again with the high profile defaults of First Brands and Tricolor. And that unfortunately coincided with kind of some more clarity that we're going to see rate cuts coming in the fall. Not unfortunate for the markets, of course, but unfortunate for net interest income on BDCs. And a lot of people are wondering if this is the canary in the coal mine. And we think the simple answer is just no. We think those defaults were more idiosyncratic in nature rather than systemic. And the stability that you see in high yield bonds here and senior loans shows that credit conditions didn't significantly worsen across the markets. And that's really the point that I'm going to be driving home here over the next few slides. We don't believe that this is the first cockroaches showing up, like Jamie Dimon said. Of course, we're late in the cycle, so more cockroaches should show up, but we don't believe that's systemic. Instead, we think it's an overreaction to really a perfect storm of bad news. Fundamentals didn't break. BDCs were just the first and really most importantly, and this is what we're going to keep coming back to, the easiest thing to sell. So Coulter, if you can move on to slide 7, you'll see that BDC portfolio construction has actually become more conservative since COVID. And if this were a replay of past credit cycles, this slide would be flashing red, but it actually shows the exact opposite. Chart on the left shows that exposure to first lien loans has been gradually increasing since late 2022. And at the same time, junior capital has been decreasing. And then the chart on the right shows that BDC leverage peaked around 2022 and has been trending lower since. And I'd say this is exactly what you want to see at this point in the cycle. So structurally, BDCs, they're actually positioned more defensively than they were through past periods of volatility. And hopefully this conservative posture mitigates any losses in the future if we do start to see some more cracks forming. So portfolio construction has become more conservative. Flip over to slide 8.
Yep, and I just want to jump in here real quick. And I think it's important to also note that each of these BDCs, they are actively managed, so they are aware of sort of the business cycle itself. And, these BDC managers are very well aware of where they're going, and they're actively, in trying to position their portfolios to best reflect, their views and the outlooks that they have. And so, over the last couple of years, it's been pretty evident that we've been sort of in a late cycle market. And so obviously that would mean that, they would want to lean into some more higher quality first lien loans. They might want to reduce their leverage. So I think it's just an important point to note that, there are active managers who are managing these loans or these BDCs. And so they are working to try and position their portfolios best for whatever environment that they see coming.
Perfect. Thank you so much. And this slide right here, this is, I think, the simplest and most important reality check on the entire space, on credit quality and fundamentals in the entire space. So this shows non-accruals. And non-accruals are where any of the underlying loans stop paying interest to the BDC manager. And in real credit downturns, this number spikes quickly and remains elevated. You can see that during COVID in 2022. But what we're really seeing is non-accruals hovering around 1.25%. And as you can see, even from before COVID, that's really well below long-term averages. And this tells us that borrowers are still able to pay their debts, and we're nowhere near crisis level behavior. That one's a pretty simple one, but I think this is really the most important. Coulter, anything else to add on that?
No, I would just note that, there's over the last, if you go back a couple of years, sort of during the height of the sort of rate hiking cycle, where we saw the fastest rate hikes basically in history, there's a lot of discussion around at that time, is this going to drive a recession? Are we going to be able to, thread the needle? Is this going to be a soft landing, a hard landing? And now fast forward to today, all those conversations have largely disappeared, because it's been proven that the economy here in the U.S. has been amazingly resilient, more resilient than many have would have thought. And so I think that number you showed here, and these non-accruals, I think kind of reflects that in a way, that the broad concern around a substantial or systemic recessionary period within the U.S. or economic slowdown really hasn't materialized. And in fact, we're actually seeing sort of the opposite. We're seeing increases to GDP forecasts here. So I think that's sort of reflected here in this chart.
Yeah, perfect. All right. And another really important thing we look at is loan pricing. And that's what you see on this chart. Throughout the volatility that we saw in 2022, you can see in the middle there, kind of the middle left, we saw prices dip significantly on both first lien and second lien loans. And we've gradually been recovering towards par ever since. So if lenders were generally and genuinely worried about recoveries, loan prices would again be falling materially. And instead, what you see here is first lien loans are still trading around 99% of par. Second lien loans are trading somewhere in the 97 to 98 range. And then if you take a look at the lower chart there, you can see that the number of loans trading in distress remains well below the levels that we saw in both 2020 or 2022, where only 11% are trading between 80 and 97% of par. Only 3% are trading below 80% of par. We consider that really in distress. And you look back at some of those figures in 2020, and we could have anywhere upwards of over 50% of the loans trading at those levels. So we're not really seeing that yet. And we think this really tells you two things. One, the market still expects these loans to be money good. And two, recovery expectations remain high no matter what happens moving forward. So again, publicly traded BDCs prices move significantly in 2025, like the BSD, the publicly traded BDCs, those prices move significantly, but the actual underlying loan prices did not. And that's exactly what you're seeing in this chart. So to Coulter's point, potentially an overreaction to not much actually happening on the underliers. And now let's move on to slide 10. I mean, this comes up in all of my conversations. So far, we've had conservative portfolio leverage, non-accruals, and loan prices that don't really scream crisis levels. But in all of my conversations, I mean, PIK comes up first, and people are really uncomfortable with it. So we're going to talk about it directly, and this chart is perfect for that. PIK usage has increased from the extremely low levels that we saw in 2022, and you can see that here. But context really matters here when we're talking about this. Today's PIK levels are really half of what we saw during COVID, and you can see that where they spiked during COVID. And even more importantly, much of the pick we're seeing today is actually strategic and not really a sign of distress. So when I say that 90 to 99% of the pick we see in our portfolios today is actually negotiated up front as a selling point, just for winning new business. And it's not a sign that companies broadly aren't able to pay back their loans, but instead it's a sign that BDCs are exhausting every possible option to boost their return on equity in this high interest and, more importantly, highly competitive environment for getting loans. So fundamentals look fairly stable across the board. Portfolio construction, from portfolio construction to borrowers' ability to pay back their debts. And the rise in PIK income seems to be less pointing to distress and more to BDC managers taking advantage of everything that they've got to win these loans.
Yeah, and I'll jump in here as well. I think one important part here is, the reason for some of these structural picks, sort of at the origination of loans. And, I think one of the dynamics over the last year or two is really sort of a more competitive direct lending market. So the BDCs have actually even moved up market cap in terms of the EBITDA size of these portfolio companies they're making loans to the point where they're now competing a little bit more directly with the larger broadly syndicated loan market. And so because of that competition, you're seeing a little bit in terms of, narrowing spreads. But also, one of the advantages that these BDCs have is that they have the flexibility to offer, basically a more flexibility to the underlying portfolio companies as well by offering them essentially, a 2 or 3 year period up front at the origination of the loan of basically, pay in kind, which essentially just defers some of the interest payments towards the later half of the loan. And that gives the portfolio companies a little bit of extra, cash flow up front in order to use that to fuel their growth even further. So there really is, you need to bifurcate, sort of good pick versus bad pick. And I think Nico, you did a great job highlighting that here.
Yeah, and I mean, you look at some of the earning calls from Blue Owl and Ares recently. I'm looking at them on the side of my screen right now. Blue Owl is talking over 97% of the PIK income was structured at the initial underwrite in their portfolios. So only 3% of that payment in kind was needed after the fact, after those were originated. And then when we're looking at Ares, they're even talking directly into their software book, and they're saying 100% of the payment in kind in their software book was created at origination to try to win those loans. So again, like Coulter said, there's good pick, there's bad pick. A lot of what we're seeing in the increase is good pick. Of course, we're going to keep our eyes on that and make sure that doesn't move in the other direction. And then perfect. This brings it home. This really gets back to the opportunity that we have here. Over the course of just a few months, and you can see it on the right side of the chart there, publicly traded BDCs sold off from a 10% premium to a 10% discount. And as you've seen, this was mainly due to panic selling and a new interest rate environment more than a significant deterioration in fundamentals, especially when we look at loan construction, non-accruals, loan pricing, PIK levels. None of these are really flashing red despite the volatility that we've seen. Of course, now we have to keep eye on the sentiment that we're seeing in the software space. I mean, some of those cracks just started to form, and we have to see how much more that leads to selling pressure. But historically, buying BDCs when fear gets ahead of fundamentals has led to very attractive entry points and very attractive subsequent returns. So just to recap kind of everything I've said here, and I've probably recapped this enough, sell-off was driven by sentiment and liquidity and mechanics of publicly traded BDCs, not a breakdown in credit, in our opinion. Public BDCs absorbed the fear first because they were that liquid escape hatch, or as Jan said it, that pressure release valve. And we think fundamentals are really remaining intact. Portfolios are more conservative than in past cycles, and valuations really already affect a much worse of an environment than we're probably in today. And with that, I'll pass it back to you, Coulter.
Excellent. Thank you, Nico. And I'll talk a little bit about our approach at Van Eck, our strategy. our BDC income ETF, BISD, as well as sort of the importance of a diversified approach within this space. Because as I mentioned earlier, these BDCs, they all are sort of actively managed, and so with that, you do get differences in underwriting standards. Some managers will focus on different areas of the market, whether that's lower middle market companies or upper middle market companies, so larger or smaller size companies. Some will even focus specifically on sort of distressed situations, while some are more core direct lending. Others might focus, broadly across various different sectors. Some might focus on technology or healthcare. So I think ultimately what I'm trying to say here is that amongst the universe of BDCs, while they all are within the sort of direct lending market, they can focus on different areas of that market. And so it's important to sort of, take, I think we believe, a broad approach, a diversified approach when accessing this space. And so you can see here, this chart is essentially showing sort of a scatter plot of the return on the left-hand scale versus sort of the volatility on the bottom. And you can see here, there's a wide dispersion amongst the various BDC managers out there. And so it's important to take a diversified approach, and you can kind of see what that results in. So in the orange dot here, that is our fund BISD, and each of these blue dots are the underlying BDC holdings within BISD. And so you can kind of see when you take a diversified approach, you get still a very attractive return and yield profile, but it helps reduce much of the volatility and dispersion of returns that you see across the broader BDC space. So, I think unless you're, an analyst and you're wanting to spend the time and have the expertise to dig into the actual loan portfolios of all these various 25, 30 plus BDCs out there, really for many, clients, as they do with other areas of their, sort of equity exposures and whatnot, a sort of market cap weighted broad exposure, really can be a great way to, gain exposure to the space without having to, become an expert on the nuances of each of these BDCs. And that's exactly what we offer here at Van Eck with our product, BISD. We've been in the market for quite a while. We're the largest BDC ETF in the market. We launched back in 2013, so we have a very long track record, a decade plus of returns that you can look and see, how our product and how the BDC market has, performed over various market cycles. We've got about 1.6 billion in AUM, so we're quite liquid. We've been around, the block for a while. We try to put as much content as we can and keep our clients informed. So we have a lot of great insights on our website and on webinars like today. And of course, the yield within the fund itself is quite attractive as well. You're getting about, call it 11 to 12% yield based off of the 12-month, yield. And so, if you're looking to gain exposure to the area, a product like ours, BISD, is a great way to do that. It's a passive, broad market cap weighted approach that gives you the yield benefits and the diversification benefits of private credit through, a broad, diversified, publicly traded BDC portfolio. And you can see here, despite some of the volatility recently, which Nico spent a lot of time discussing already, the longer term returns, in the 3, 5, and 10 year, and even since 2013 have really been quite attractive, within the private credit space and BISD in particular. So with that, I guess I'll jump into questions. I know we're kind of coming up on our time limit here, and we've got some questions that have come in. So let me jump to, I've got one for you, Nico, that maybe you can kind of touch on real quick. And this is probably one of our most asked questions. It has to do with the expense ratio. So for many of those, if you've noticed that BISD has a very high expense ratio that we show, but partially that is due to regulatory reasons, but I'll hand it off to Nico to kind of cover, why the expense ratio seems high.
Yeah, totally. And I'll try to be super quick here because we do have a bunch of questions, and maybe we should try to rapid fire some of these. SEC rules for fund of funds means that you have to show a weighted average cost of the expense ratios of all the underlying funds. So that shows up on our website as 12.86%. But the actual management fee of BIZD, which that answers another question. That's the Van Eck BDC Income ETF is BIZD. The actual management fee is only 40 basis points. So NAV every year is reduced by 40 basis points, just like any other 40 basis point expense ratio ETF. But we have to show the weighted average cost of all of the underlying BDCs that we hold. And of course, those have their own management fees, but plus performance fees. And those add up on a weighted average basis to about that, 12.44%. And then you add on the 40 basis points. So that's the expense ratio. Coulter, what do you say we make a quick comment on all of this data being through Q2
Yeah.
and not live? Because obviously that's an important one.
Yeah, I think one important thing to note here for BDCs, they report on sort of a 1 quarter lag. So data we were showing here from the Houlihan report is as of Q2. I would expect that the most recent data is Q3. I would expect their report on Q3 to come out essentially any day now. So do keep an eye out on that. I mean, Houlihan puts out a great resource and it's publicly available. So check out their website. I think we've got a link in the webinar as well. So yeah, so some of this data is from Q2, but Q3 is really the most recent data. BDCs are just now starting to release their Q4 data. We've just seen like 1 or 2 BDCs, and they'll continue reporting basically all the way through February into March. So do know that BDCs do report on sort of a 1 quarter lag. So obviously keep an eye out for the most recent report, which I would expect from Houlihan before too long here shortly.
Yeah, and that said, I mean, I think the most important point and why we still feel comfortable talking about this is we saw significant volatility through Q1 and Q2 without seeing credit conditions deteriorate all too much. So we're comfortable in saying that the picture of the BDC market looks a lot worse than we think the deterioration of the underlying credit conditions. And that's the point that we're trying to make here.
And let's see here, I'll kind of rapid fire through one more because this has been a topic that's come up kind of more recently is on the software exposure within private credit and how that kind of relates to BDC. So of late, the software, sort of, and you're seeing it more broadly than just the private credit market. You're seeing basically it kind of started with the earnings from Microsoft last week, and now you're seeing sort of a sell-off and sort of a narrative fear, if you will, of AI kind of disrupting the software companies. Well, I do think there is some, that obviously is an area that I think we need to keep an eye on. I think potentially seeing such significant sell downs, and if you look at places, companies like Oracle are down 40-50%. There are very extreme sell-off in sort of, in that software area. And the private credit market does tend to have a little bit higher exposure to software companies. If you look at the broad BDC space in general, it's around 20% is the numbers that I've seen quoted. It's a very large area. So, kind of great, I guess, kind of ballpark area. When we look into BSD itself, because we are a broad, passively indexed vehicle, we basically represent the broad BDC space. So our exposure to software within the BSD portfolio is similar to what you see broadly. When I measured it, kind of back in napkin math, it was a little bit lower, about 17%. But generally speaking, kind of in that area. So that is one area that we're keeping an eye on. There has been a lot of discussion around that. I think the discussion around that is still very new, and perhaps the narrative may have gotten sort of ahead of the fundamentals there. That is obviously one thing to be aware of. But broadly speaking, we are also seeing, if you look at the BDC space, the public trade BDC specifically, you're seeing really already kind of much of the market discounting a lot of that sort of credit risk already within the market, as Nico's pointed out. The price to book or the price to NAV of these BDCs in aggregates, call it 0.9, and I think perhaps even if you were to look today or as of yesterday, you probably even upper point 8 or 8.9. So I think you're seeing much of that risk largely already priced into much of the BDC space already. So, but with that, I guess I'll wrap up. So we are sort of already a couple minutes over time, and we want to be respectful of everybody else's time as well. But wanted to at least highlight, if you have or want more information about our product or other products at Van Eck, please do visit our website at vaneck.com. We also have a subscription there where we put out a ton of content in terms of blogs, webinars on things like BSD and private credit, but also on all the various other asset classes that we cover here at Van Eck, which is essentially most of them. So please do go and check out our website and our content there, and subscribe for all of our content that we put out. And thanks again for joining us, and thanks, Nico, for joining me.
Thanks, everyone. And reach out to your relationship manager if any questions were left unanswered, and Coulter and I are happy to hop on some calls.
Appreciate it, guys. Have a good day.